All right, all right. Debbie Taylor is coming up next. But before we get started with her presentation, we have another poll for you. Now, this is a point of contention and controversy amongst the Holistoplan team internally. So just prepare yourselves. How do we feel about candy corn? And for the purposes of this poll, this also includes the candy corn pumpkins.
Because people seem to have a different opinion about those than they do just regular candy corn.
And I think they taste the same and the texture is almost the same, so close enough that I want to include them. I am loving the split of these results right now.
Well, they kind of were jumping all over the place for a second.
But it's basically neck and neck.
Should we share how we feel, Alana? Because I'm a hate it kind of
I
person.
love it. I love it. Specifically, I love the pumpkins. But I also I like candy corn. I love the candy pumpkins.
Hey,
My gosh. These results are still pretty tied. Ben Birkin somewhere
is rolling in his
punched a wall or something. He
yeah,
cannot stand this.
not rolling in his grave. He's still alive, but he's upset for
Look
sure.
at that. Look at that. So close. Incredible.
It's good stuff. Well, that's perfect. That's a perfect intro for who we're bringing on today. So we're joined today by Debbie Taylor. Obviously, if you have been a part of Holistic Plan for any amount of time, hopefully you should know who Debbie is at this point. But I still will give her an intro. She is the managing partner and chief tax strategist of Carson Wealth Franklin Lakes, a full service wealth management firm. She's located up in New Jersey. She's got a huge passion for tax planning for families and educating and empowering women and their families to take control of their future. She advises in all areas, including investment management, insurance, complex tax planning, retirement planning, and estate planning. She has a ton of industry honors. She's authored hundreds of articles and she has a book on best practices. She lectures all the time. And she has hosted the weekly radio show Wealth Matters. She offers a lot of financial tips to people. She's a certified public accountant and a retired attorney. She graduated from Cornell, and she's a certified divorce financial analyst. She also has her Series 6, 7, 24, 63, 72. We could say so many more things about Debbie. But really, you'll get to hear from her today. But to get to know her a little personally, she enjoys spending time with her family, exercising, traveling, and reading. So we can have Debbie enter in from our backstage and we can hand it over to her and Greg. Debbie and Greg.
Hey, Greg.
That was perfect
It's all
timing. It's
right.
like,
It's all right. I'm used to it.
and Greg coming in with her as well. This
Pro,
feels, oh, here we go.
I'm sorry, we good?
Yes,
Yes,
we're
you're all
good.
good, Debbie.
Okay. I have no idea how that poll ended up pro and con equally for candy corn. Okay, so we're gonna have to do some continuing education on that front. And when you came on, we were talking about the love of my life, Maxie, who is my Maine Coon. And so yeah, so when you came on, we were talking about that. Who's also orange, so he's ready for the season. Okay,
Oh, very
so that's perfect. So let's hop in. I also want to introduce Greg Schultheis, who is here. And for those of you who've been tuning into the monthly Holistic Plan webinars, Greg has become my trusty sidekick, or maybe I become his trusty sidekick. I'm not sure which one. But welcome to Greg. He is a CFP. He's got a lot of great tax planning experience. And he and I do most of this work together. So just want to acknowledge Greg and how amazing he is. All right. So are we sharing our screen? Where are we right now? All
I
right.
think Greg's got you.
There we go. Good. All right. So let's hop in. So interestingly enough, and I know some of you have been with us for hours, so thank you. And I'm going to try to spruce this up and make this as sexy as possible because tax planning can be sexy, right? If you have the right person presenting it. And so Roger had mentioned a couple hours ago, a little shout out, that we had done a good job at our firm of scaling up on the tax planning, right? At basically pushing down a lot of that work, creating really good systems, really good templates, training the team, and leveraging Holistoplan and the resources within Holistoplan. And so I do want to encourage all of you to think differently about it. Tax planning is not just for those top 10 clients, and it's not reactive, right? With the software, with Holistiplan, it does enable us to dig deeper in our books, to be proactive, to create that service calendar, and get that tax planning services, out to the clients. And so just want to acknowledge that and reinforce that message. About leveraging the team. And then it was so nice to see Jamie up there, because Jamie and I have worked together, and he's just such a source of great information. And so moving along then, going to what are we going to talk about today? So we've got 7 tax planning challenges and opportunities under OBBBA. So we are going to talk about OBBBA a little bit. For those of you, it might be a little bit of review, but I find that every time I sit down to a podcast on OBBBA, and I'm still doing it, the AICPA has them, different accounting firms, folks are still coming out. I'm still reading articles. I'm always learning something new, or another wrinkle, or another way to be thinking about it. And so when I talk about OBBBA, when I talk to my team about it, I say, look, the first thing is sifting through the rubble, right? Is OBBBA comes out, it's 900 pages, there's over 100 provisions, there's a lot of misstatements in the press on OBBBA, okay? And a lot of misstatements when you Google, and even when you do AI searches. So you need to be careful, you need to go to trusted sources. And even now, we're still getting misinformation, because right after OBBBA was passed, there was, a sort of a real rush to get information out to people. And at times the information was based on a previous version, right? The House version or some previous version. And so then that got out into sort of the mainstream, and then it gets picked up, it gets repeated, and some of it is still out there that's not completely accurate. So you've got to sort of sift through the rubble. That's like the first layer of thinking, the most basic layer of thinking, right? Is just understanding like the what, like what is this? But then the next layer of thinking is, what to do with it. Like, how does it present a risk? How does it present an opportunity to us? And so that's really the next level of thinking. And that's where Holistiplan is so powerful, because OBBBA, if it did nothing else, it has complicated the tax code. And there's no question about that. That cannot be debated. It has complicated the tax code. And with more complication, you need more modeling. And again, that's where Holistiplan comes into play. And so I was sitting on an AICPA podcast, and I think it was Bob Keebler, and he mentioned like no drive-by recommendations, right? And that's become my new favorite term, is no drive-by recommendations, because you're going to open yourself up to liability if you start just talking like, oh, Roth conversion, yeah, that's a great idea. Well, it's a great idea, but OBBBA has this really aggressive phase out in a number of different areas, and it could cost your client tens of thousands of dollars now in additional taxes that they may not have anticipated if you do not model this out thoughtfully. Okay, so no more drive-bys, no more drive-bys. Okay, so we're going to talk a little bit about OBBBA, and then some angles in connection with OBBBA. And then Greg is going to take the lead in areas 2 and 3, is digging into the software. And I know, that can be a little bit dry sometimes. And so Greg's laughing, and I tease him about this. And so I'm going to try to make it interesting as he gets into the software. But this is one of the reasons that you're getting the CFP credits, is because we are going into the software. So it does qualify. And then some bonus material wrapping it up. And I think we're supposed to be done at 3:05. All right. So next slide, 7 tax planning challenges and opportunities from OBBBA, right? And so here's where we want to start. Is OBBBA basically made permanent, and let's just talk about that for a second, right? Permanent in Washington is not like permanent in the real world, right? Permanent is small p, permanent is written in pencil. So whenever I say permanent, it is with that disclaimer that can change, right? That can change. And so when you're thinking about planning for your clients, I don't want anybody snoozing here. I don't want anyone doing victory laps. This is the tax law for now. But that doesn't mean it's going to be like this 4 or 5 years from now. So just keep that in the back of your mind. Okay, this is hysterical. What does Debbie like to read? Did you see that question?
I
Okay,
did.
that's
I was waiting for you to see that
that's
one.
hysterical. So the question is it business reading that you're curious about, or my leisure reading? Obviously, like 80% of my life is business reading, right? So I'm addicted to Journal, Barron's, and I love The Economist. And then I do read all the trades, right? I read all the gossipy trades, for our industry. And then in my quote spare time, I do enjoy historical fiction, and I read a lot about World War II. But I love historical fiction, and I'm curious if you have any recommendations. You can drop them in the chat. So anyway, that's my thought there. Okay, so back to this. So so OBBBA made permanent the lower tax rates, 7 tax brackets set up from TCJA. And remember, the big risk was 37% going to 39.6%. Obviously, that did not happen. A few little wrinkles on that. They added an additional year of inflation adjustment to the 10 and 12% tax brackets beginning at the end of this year. What does that mean? That means that we're all going to be in those lower 10 and 12% tax brackets for a little bit longer, which is a good thing, right? So that's just a little wrinkle. What you want to do here is focus on long-term capital gains rates then, which are continuing to be preferenced for most of us. The other thing that OBBBA did, and again, I'm trying to mention some of the things that you might not have seen on the surface, right? This is sort of the behind the scenes stuff, is they limited the benefit of itemized deductions to 35% if you were basically in that highest tax bracket, that 37% tax bracket, okay? So there's a little bit of a complicated formula, but the bottom line is that if you're in the 37% tax bracket, then your itemized deductions are going to be limited to 35%, even though you're in the 37% tax bracket. And this is what you're seeing more and more, is that Congress doesn't want to change the tax brackets because they know that it makes for bad news. And so instead, what Congress does is it tinkers around, right? It creates the Secure Act. It creates, a P's limitation, which of course is no longer law, but you're getting the picture. Is now your itemized deductions are limited to 35%, even though you're in the 37% tax bracket. And so you've got to be aware of all of these sort of backdoor ways that the government is trying to raise taxes on our clients. And again, that's why holistic plan is so important, because if you showed up with your handy dandy like tax rate schedule or tax bracket schedule, which I'm absolutely addicted to, and I don't go into any meetings without this, all right? Any meetings. It's my little cheat sheet. But remember now, these tax brackets only tell part of the story, right? It's almost like a starting point, but then you've got to realize, oh, within the 24% tax bracket, I could have all kinds of phase outs. So is it really 24% or is it possibly a higher number? And so this is like your starting point, but then holistic plan is how you end it, with the precision, right? With the precision and the confidence. Okay. So we've got a limit then on our itemized deduction. So remember, for your wealthier clients, then a lot of them might have investment interest. That's going to be limited, right, to that 35%. And again, that begins next year. Also, again, some things to think about high level is the tax cliff in the late 2020s. Now, nobody knows what's going to happen when a lot of these provisions expire, because many of them are temporary, particularly the Trump promises are temporary. So a lot of them are going to expire in the next few years. And again, most people aren't even talking about that. We're just trying to sift through the rubble now. But you, the planner, need to be thinking and possibly doing multi-year projections, multi-year analysis, and maybe not so much today in 2025 or 2026, but definitely in 2027, 2028, because it may make sense then to be accelerating income or deferring income, depending on the client situation and what tax breaks we're looking for, what phase outs we're dealing with. And so again, something to keep in the back of your mind. Now look, those multi-year projections can even make sense now in certain instances, but certainly as we get to the end of these temporary provisions. So again, we got to start thinking a little bit differently. The other thing is your clients should probably start tracking their deductions again. They haven't done that for the most part since 2017 when the TCJA was passed, because 90% of your clients are taking the standard deduction. So they're just like, we're good here, right? I'm taking the standard deduction. Their tax preparers are thrilled, because the last thing they want is that shoebox of receipts. And I used to prepare taxes, and I remember those shoe boxes, and it was ridiculous. Okay, like, why aren't you adding this up on your own? Why are you showing up with a shoebox of pharmaceutical, CVS, and Walgreens receipts and expecting me to add $10 and $12? But yes, that's what used to happen. And now, for years, that doesn't happen anymore because 90% of clients were taking the standard deduction. And so the CPAs were more than happy to just be like, yeah, we don't have to deal with that anymore. Now, there could be a possibility with a $40,000 enhanced or expanded SALT deduction that some of those clients could be back to itemizing. We don't know what those numbers look like yet because we've got to go through a tax season and then it will be reported. And I'm really curious to see how it sort of how it comes out. But in the meanwhile, you should be preparing your clients to collect those receipts because some of them may start itemizing again and they need to start paying attention to charitable deductions again and some of the other areas that they're still allowed to itemize, mostly charitable and medical, mostly. So that's another thought, sort of a change. No drive-by recommendations we talked about. And then again, taking a step back. What is the name of the game here? And the step back is we want to pay taxes at our lowest lifetime rate and offset taxes at the highest rate. So we want to pay taxes at our lowest lifetime rate. And so the modeling, the long-term thinking still needs to win. So yes, we've got a lot of noise now. Oh, this phase out. So if I do a Roth conversion, it's going to drive up my IRMA surcharge this year. I'm going to lose part of my enhanced senior deduction. I get that. Nobody wants to leave money on the table. I still use coupons when I go to the food store. I get it. But remember, the bigger goal is paying less taxes or paying taxes at your lowest lifetime rate, which could mean paying more taxes now and less taxes down the road. And we can't lose sight of those goals. So you're going to do holistic plan modeling and you're going to disclose and you're going to show to the client, hey, you're going to lose $3,000 of your enhanced senior deduction. You're going to lose $5,000 of that SALT deduction. And yeah, that totally stinks, but we have modeled this out and this Roth conversion makes sense. And by our calculation, it will save you $200,000 or $300,000. And by our calculation, it will increase a Roth account from 100,000 to 700,000, whatever the numbers are, and could potentially then leave that large Roth account to your heirs, which will be subject to that 10-year rule. And that would be a huge win for them because that account can grow income tax free. And so you've got to be ready, brush off those arguments because you have to be ready for more pushback now than ever before. Okay, more pushback now than ever before. All right. So 900 pages, 100 provisions. We have old provisions that were renewed and extended. We now have provisions from TCJA that were updated, right, and modified. Like what? The child tax credit is now $2,200. So that's an example. The QBI, 20% of qualified business income deduction, right? Tax brackets were updated. The SALT deduction went from $10,000 to $40,000. The enhanced senior deduction, right? Which, by the way, we could do a real good poll on this. What is the total standard deduction now for a couple that is 65 and over, right? When you add in the regular standard deduction, then the senior, and then the enhanced senior deduction, and I'm gonna save everybody a lot of time. It is $46,700. $46,700. That is a lot of money in standard deduction. Okay. With this legislation, because they had to satisfy the Byrd rule and how the budget restrictions where it's got to be revenue neutral and the 10-year limit, right? Is you've got to remember the gimmicks. I call them the gimmicks, right? The buts. So yes, you have this deduction, but it phases out, but it's temporary. So always remember the buts. The devil's in the details. And so remember when things begin, when things end, because some things are retroactive to the beginning of this year. And remember, some things are permanent and some things are temporary. Okay. Let's go to number one, new or expanded tax breaks. And so we talked about some of this a little bit, is the SALT. So the SALT deduction went from $10,000 to $40,000, but phases out $500,000 to $600,000. In that phase out range, there is a 45% marginal rate in that phase out range, even though the client, if they're $500,000, is basically in the 35% tax bracket, okay, married filing joint. So you have a 45% marginal tax rate for those extra dollars between $500 to $600,000. And so again, you've got to be careful there and really justify that Roth conversion, and Holistic Plan is going to help you do that. Huge marriage penalty on this. The SALT. So remember, you've got two individuals. They make $500,000 each, right? They make $1 million together, but they're single, right? They're single. They're separate. They get an $80,000 SALT deduction between the two of them. Those two marry. Now they have $1 million married filing joint. They only get a $10,000 SALT deduction. So huge marriage penalty there. What are some ways out of the SALT limitation, right? For those higher earners, those folks over 600,000, or maybe between 500 to 600, is that PTET. And that PTET is available in 36 states. So make sure that your clients who are operating businesses that are partnerships, single member LLCs, S corps, right? They should be considering the PTETs in states that have income taxes, and it's 36 of them, and that gets you, mostly out of that SALT limitation. Okay, so that's one of the options. The other things that we're hearing about, which again, it's like what is like old is new, what's new is old, right? Is these non-grantor trusts. And they talk about stacking the SALT limitation so that, again, you make too much money, you're limited to $10,000 on the SALT. But if that business, if that real estate gets broken up into non-grantor trusts between 3 children or whatever you're doing, then each of them potentially could qualify for these tax breaks, right? Including that SALT limitation. Now, of course, the flip side of this, before the chat blows up, the flip side is that you're paying taxes at that trust rate, which is, obviously a much higher rate that kicks in at $15,000. So I'm not out here saying, oh, this is going to work every single time. What I'm saying, though, is that a lot of CPAs are talking about this. And it could be an option in certain instances. And that's what you want to be aware of, and then possibly model it or think it through with the client. Okay, enhanced senior deduction, that is available up to $250,000. So again, I am pointing out what I consider to be two of the most powerful tax breaks that have come through as part of OBBBA. One of them has a $600,000 at the end as the phase out. That's the SALT opportunity. The other one is the enhanced senior deduction that's worth $12,000 to a couple, completely phases out at $250,000. Remember, that's retroactive to the beginning of this year, and it's over at the end of 2028. By the way, think about it. The average Social Security is $23,000 a person. That adds up to $46,000, and that's basically about what a senior couple has now is the standard deduction when you layer all the different standard deductions on. So sort of ties out. Okay. One of the other things that's sort of interesting is educator expenses are now unlimited if you itemize. Okay, that's one of the wrinkles you might not have heard too much about. You have to itemize, but educator expenses are unlimited. Isn't that nuts? So if you have any teachers that are out there, that begins next year, you might want to be talking to them. And so one of the things you want to be thinking about is segmenting your book and sort of thinking, okay, these folks are earners. Here are the aspects of the OBBA that are going to apply to them. These folks are retired. Here are the aspects that apply to them. And here's small business people, and here's high earners. I would tell you those 4 categories right off this top you should start with. And Roger was talking about adding tags. That is one way to be thinking about it, right? Your earners, your accumulators / earners, your high net worth people, your seniors, and your small business owners, because there are so many tax breaks that are connected with those 4 groups. All right, number 2. I'm moving a little bit slowly here. When am I supposed to be done with my section, Greg?
You keep going.
Okay, because Greg and
We
I were
were,
going to split. What's that? I didn't
we,
want
I,
to
we
take
were,
what?
that's fine. You take my part. No, I was thinking around 2:35.
2:35. I'm supposed to be done? Are you kidding? All right, I got to get going here. All right, number 2, we got to revisit Roth conversions and distribution planning. And again, we really ideally want to try to avoid that 500 to 600 range. But if you've got a compelling case for doing that Roth conversion, then I'm all ears for that. Okay, and so That's something to think about. We also can offset and match with the QCD. Again, the beautiful thing about Holistiplan is like you can just dump it all in there. It's like a crock pot, right? You just like dump it all in there and then it comes out beautiful, right? It comes out, the flavors meld, you understand like what you're doing. And so maybe we play around with that too. I want every single one of you to have disclaimers on the top of your Roth conversion emails. We create a special disclaimer on the top. It is bold, it is yellow, and you better be warning these clients about the OBBA, and certain phase outs could be affected because their CPA is going to be thrilled to tell them about that next year at tax time and basically blame it on you possibly, right? And the client might forget these conversations you're having, the rationale you gave them. So you want to make sure at the top of that email is like, hey, Roth conversions could increase your taxes, particularly more so under OBBA, and then specifically cite I did the enhanced senior deduction and the SALT. Now, if you're in Nevada and you've got a lot of people that work for tips, well, by all means, you might want to reference that as well, right? But I'm saying, like, depending on your clients, I would have some disclaimer at the top of that email to make it super clear what's going on, okay? Let's still focus on our long-term goals, right? Even if some of these things phase out a little bit, we got to see the big picture here. But to be clear, particularly in that 500 to 600 range, it is a minimum 45% marginal rate, and it could be closer to 70% or higher if you're also pushing down the QBI or if you've got a client in a high tax state like California. So it's a total danger zone, that 500 to 600. All right, number 3, expanded 529 and new Trump accounts. Greg, was I really supposed to be done at 235? Are you kidding? I don't
No,
understand.
call it 240.
Okay, this is crazy. Okay, okay, 529s. This is so cool. What's happened with 529? So remember, it was $10,000. They keep expanding it, and what they did this time on OBBA is they expanded it both ways. So now you can go younger, right? Elementary, secondary school, expanded the qualified expenses, tuition, curriculum, books, tutoring outside the house. So mom or dad, you can't charge for tutoring and run it through the 529, right? Testing fees. Did you think about that, Greg? That's what I thought about, because I would have collected a lot of money from the 529 as a qualified expense if I charged for all the tutoring for my 3 kids. Okay. And so they're saying, oh, no, no, you can't do that. Right. And so you get to those all now qualify. So think about this. It's starting from elementary school from the time your kid's like 5 years old. And then it goes post secondary to credentialing programs, CPA, CFP, stuff like that. That is post July 4th, 2025. And next year, it's $20,000 that you can take out for some of these expenses for the elementary, secondary school. So that's really cool. Continued expansion of the 529s in both ways, and great for your higher net worth clients that are planning ahead. Okay. Distributions are tax free, the income grows tax free, all of that. Okay. Pilot program Trump. Let's think about this. Break up the Trump accounts in 2 ways. This is super confusing, and a lot of what you Google is wrong. So be super careful in this area. This is one of the things that was changed at the 11th hour, and a lot of stuff is wrong out there still. Think about your Trump accounts in 2 ways. The first part of the Trump account is a pilot account. That is that $1,000 that you heard about coming free from the government for children born between 2025 2028. So that's the pilot part. Okay. And look, unless you're totally paranoid of the government, you probably should be applying for that if you've got a child that age. Okay. Then think about the other part. And the other part is very much like an IRA for children. And that part is you can have contributions up until the year before the child turns 18, right? The year before the child turns 18. And you can have contributions of $5,000 a year. Employers can contribute, charities can contribute. There's all these different ways that stacks up. And they're available in July of 2026. So one of the reasons you're not hearing so much about it now is because it goes into effect a year after the OBBBA was passed. So we'll start hearing more about that probably early next year. Here's what I'm going to tell you, the bottom line on the Trump accounts, right? Is there are so many ways to save for retirement, for education, right? It would have been nice if they simplified the law in this area. They did not. They went the other direction. But here's what I would tell you. 529, in my view, still wins most of the time when it comes to education. Again, particularly as they've expanded it, made it more flexible, and now you can take $35,000, get it into a Roth IRA. So really cool, the 529, if you really know your way around it. Here's where the Trump account is cool. for your higher net worth parents and grandparents who want to start seeding and building that traditional IRA for that child, and the child doesn't have earned income because the child is 1, the child is 2, the child is 3, okay? And so my children, we started their Roth IRAs for them when they were 10 because they worked in my business. Not everybody has that option. And so now this is an opportunity for wealthier families or planning ahead, parents, grandparents. You could start $5,000 in year 1, and it's going to be adjusted for inflation. You could go then 17 years putting that money in. And that's pretty cool. It doesn't require earned income. It's basically treated as an IRA. We're waiting for additional guidance from the IRS on that. Okay, next one, revisit entity type and business tax deductions. There is so much I could say on this, but I'm not, because Greg is giving me all kinds of time deadlines. He's very difficult to work with sometimes. And so anyway, so here's what I'm going to say on this. If you've got a client that has a small business of any type, if it's a C Corp, an S Corp, a partnership, I don't care what it is, if they've got it, you've got to get them to a real tax preparer, a real accountant, a real CPA, somebody who understands this area, not somebody who's like doing it out of their basement, somebody who's like really serious about this. I mean, I guess you could do it out of your basement and still be really good. So I take that back. But somebody who's really serious about this, because there are so many opportunities here. We want to look at cost segregation studies. We want to look at depreciation because now there's all this depreciation. Some of it's even retroactive. We want to look at a qualified small business stock exclusion. If we're going to like go public and we like created some tech startup, okay? There's a lot here, and the expanded QBI limitation opportunities. And again, all this depreciation opportunity, and then expanded interest deduction for businesses. So much here. So much here, okay? And so please, any of your clients that are doing any of this, they have got to have a serious sit down, and you can work with them and stay in the background on this one. Okay, number 5, charitable contribution planning. New floor on charitable contributions if you itemize beginning in 2026, 0.5% floor on itemizers. What does that mean? If you do big contributions and you itemize, maybe you pull those contributions into this year. The flip side is now there's going to also be $1,000/$2,000 for married filing joint standard deduction if you have people not itemizing for charitable contributions. And those people may want to wait until next year to make those contributions, because then they'll get that $2,000 even though they don't itemize, right? Because so many people stopped contributing when TCJA was passed, okay? There are some rules around that. It's got to be a cash contribution. It can't go to DAF, right? And so there are some rules about that. So you look at that, understand that. Some might be moved forward. Some should be pushed backwards, right? Number 6, accelerate liquidity events and multi-generational legacy objectives. Here's the bottom line. Tax rates are historically low. They're historically low. And yes, technically they say, oh, it's permanent. What does permanent mean? It means the second Washington changes up, we're going to have a problem. And so let's do some tax planning now around these very low rates, whatever that means. I am coming up to the end because Greg is tough on me. Number 7, lifetime exempt tax exemption. Okay. Estate tax exemption. Okay, here's how I want you to think about this: is under $30 million for a couple. Get your documents in order, and if you're sort of button up against that 30 million, think flexibility. Let's put some of that low-hanging fruit to work. Some of these flexible trusts, slats, ILETs, grats. Okay, those are still real, and those are super powerful. Also think about asset protection and think about reviewing the titling. Let's get that step up in basis, right? Let's get that step up in basis. And so let's not say, oh, we don't need to do estate planning. We've got $30 million. Like we can just rest and do a victory lap. Absolutely not. There is work to be done here. Jamie talked about that a bit. But also remember here then, if we're not so worried about the estate tax, the federal estate tax, think about income tax, right? Think about income tax. What is she talking about? I'm talking about basis step up, right? Ill spouse, older spouse. Let's transfer, ownership. Let's also think about Secure Act, right? That's an income tax essentially on an inheritance, right? I mean, that's what it is. And so let's not just give up on this. If you've got clients that are close or over that $30 million, let's fund those trusts, possibly non-grantor trusts. Let's make those gifts. Let's get the future appreciation out of the estate, and let's get the income out of the estate for future generations, okay? And by the way, do not forget the states. States have inheritance taxes and states have estate taxes. Over 20 states have them. And sometimes they are brutal. And so we got to still be thoughtful here. Okay. And then adaptable tax planning, the key to maximizing lifetime wealth. So here's my new expression: everything impacts everything. Okay, I think there was a movie. Wasn't that like everything everywhere? Yeah, everything everywhere. Okay, so
All
that's
at once.
all at once. Everything, everywhere, all at once. Okay. So that's what we're talking about here. And so let's utilize tax diversification, right? We've talked about that. Let's build our Roth accounts. There's a great Roth explainer tool in Holisticplan. We use it for prospects. We close business with that 10 to 15 minutes. Greg is like a little magician. We have like a Roth conversion analysis, how much money in taxes we're going to save them, how much bigger their Roth IRA is going to be down the road. We close business on that, not Greg's good looks. That's not how we're closing business. Okay. We're not. I mean, Greg, I think you're very handsome, but that's not how we're closing business. We're closing business on the Roth conversion tool in Holisticplan. Okay. That's how we're closing business. Okay. So let's think about that. Let's use our Roth IRAs and Roth conversions to save on lifetime taxes. But remember, be sensitive to the OBBA, right? We don't want to trip on a little landmine there, right? Asset allocation, asset location to drive tax efficient growth. We talked about that earlier today with the two young guys who are totally awesome. And they talked about asset location for the accumulators. It is the unsung hero, right? It is great. Tax loss trading. Roger talked about that. Benefit plans and maximize retirement contributions. Roger made a reference to the retirement contributions. And then let's build these accounts: health savings account, Roth IRA, 529s, right? All those goodies, right? All those goodies. And then let's think about charity and how that can fit into our tax plan and our philanthropic plan. And then let's not go to sleep on the estate planning, right? Let's not go to sleep on estate planning. Remember here is we have had major tax legislation: 2010 Affordable Care Act, 2017 TCJA, to the Inflation Reduction Act, 2025 OBBBA. How do they do it? By reconciliation, right? By reconciliation. And what I'm saying to you is that this can happen again. This can happen again. And so let's be vigilant. Let's appreciate these low rates. Let's not trip up. Let's not be sloppy. Let's leverage Holisticplan. No drive-by recommendations. And then segment your clients: wage earners, business owners, high net worth, retirees. And with that, Greg, to you.
Thanks, Debbie. Um, that was a whirlwind, and so now I'll put everyone to sleep. A little lullaby to end our session here. No, I'm joking. We'll keep this energy going, and we're just going to jump into based on some of the questions I saw in the chat. Some of you probably know what this tool is. Some of you may not, but this is probably a tool, the scenario analysis tool in Holisticplan, that I am in every single day of every week of every month. And just emphasizing that, this isn't something that we do for clients once and then forget about, and, we come back to a new question in a couple of years. No, we're doing this every single year, every single client, because the analysis must be updated. We must look at every scenario every year, model out those various tax planning recommendations, and get clients, really great answers. So what is this tool? This is the environment within Holisticplan. It is generated and populated by the tax return. It can be customized. You don't have to have those 2024 tax figures flowing into the scenario analysis tool. But for those of you who maybe have used other tax modeling software in the past, I used to use BNA. That was a Bloomberg tax plan, tax projection tool. It would take hours to build a tax projection. This is literally minutes to build a tax scenario. So, anything that we're modeling for clients, we had a client earlier this year saying, hey, I'm thinking about converting 100% of my traditional IRA assets. And we were like, all right, let's model this out. Let's see what it looks like. So we were able to show him what's it going to look like if we do it this year. What is it going to look like if we spread it out over 3 years, over 5 years? So this is not just current year analysis. This is multi-year analysis. The software knows how to handle that. And so, like I said, it's a matter of minutes. So it's accessible from the client dashboard. And what I'm going to do is just jump over to our demo environment, and I'll show you exactly what this all looks like. So again, many of you may have seen this before. Maybe you use it. I hope that you do. But anytime that we're doing scenario analysis for clients, you can jump in right from the tax return here. So this is 2024 tax return that has already been uploaded, already been analyzed by Holistiplan, and I could jump right into a scenario analysis from there. What I am going to do is jump into my Mr. and Mrs. Champagne client here, and I'll show you. I actually have a couple of scenario analyses environments. So maybe I'm doing something just based on inheritance. Maybe I want one that's specific to Roth conversions, helps you keep organized, stay on track. You don't lose track of where you're doing these analyses. Just want to show a couple of the features again that we're using day in and day out. So one, we're constantly using this scenario bank. So if there's something that you sort of want to tuck away, let's put that away. I don't necessarily want to show that in a client meeting, or I don't want to send it to the client. You can just click these buttons here and you can send those to the bank. They'll be stored there. The solve for min-max feature is another really amazing feature. We use this all the time if we're maybe modeling out Roth conversions. We know that we're targeting a certain tax bracket. So what we want to do is just find out where that actually, where that limit actually is. So it takes a few seconds to calculate, but once it's done, and of course now that I'm promising that it's as quick as can be, here we go. It's going to show us where the next effective rate change is for ordinary income, for long-term capital gain income. So if perhaps a client is in a low-income year, you want to do some strategic capital gain harvesting to take advantage of those 0% and 15% long-term capital gains brackets. This gives you any and all info that you would need to really optimize that. One other tool that I actually, this has probably been here forever, and I discovered this about 3 months ago. So it just goes to show, even if we know the software, we don't really know it all the way, is that there's a delta feature here. So if you are comparing two scenarios, one to the other, you can bring up a delta. I was, I was literally calculating these by hand for longer than I care to admit. And so this does all that for you. It's going to show you every single difference as you go down the line all the way down to the tax implications as well. So they'll show you just how much is changing across the board. So those are just a couple examples of how we might use this. It's a really great tool. It is by far, I would say, the feature in Holistiplan that I'm using the most. Obviously, around tax time, when tax returns are rolling in, we're sending out tax return analysis using tax report. But for anything planning specific, we're in the scenario analysis. We're running these scenarios. We're showing clients what these tax implications are. One of the things that I want to just call out are these scenario recipes. So these are some pre-populated, they call them recipes for good reason, because they're going to give you a great overview of maybe what the strategy is, how you should be modeling it in scenario analysis. So if you ever have any questions, there's a handful of common tax planning strategies here that you can come to, and it's just going to give you a lot of background, a lot of information about how you can actually model that out in the software. So for instance, if you're going to do a Roth conversion analysis or a side-by-side, you can always come here. This is going to be a great resource to you. So with that, what we do want to sort of give you an overview on, we've talked about some of these items as we've been going through some of the earlier discussion around implications of OBBA. And what we do want to do is just show you what some of these modeling tools how some of these modeling tools can be used, specifically for retirees, small business owners. We're not going to be getting too in depth on the on depreciation or changes in entity. That we'll reserve that for the CPAs. But we'll show you how we can use this for some pretty impactful conversation and modeling with clients. So here we are. We've got our sports car here. No more drive-by tax planning recommendations. We put an end to that. Park the car, get out, go sit in front of your computer and run some scenario analysis. So number one, retirees Roth conversions. Why are we doing that? We're looking for that income valley. We want to take advantage of those years when income is maybe lower after retirement, before required distributions begin from IRAs, before Social Security is set to begin. Take advantage of those low rate years, low income years, when their marginal bracket is is set to be the lowest, to really just help reduce those tax deferred balances, reducing RMDs throughout retirement, hopefully saving them taxes over the course of their life, but also, minimizing IRMA surcharges. So, we see this not just as a benefit to the client or to the prospect while they are living. Sometimes it is a benefit to them, just from a lifetime taxes paid standpoint. But it's really a multi-generational planning strategy. I can't tell you how many times we've shown clients, hey, would you rather leave a $4 million traditional IRA to your children, or would you rather leave a $3 million Roth and $1 million traditional IRA to your children? Well, because of the Secure Act, because they're going to have to take that money out in 10 years. And in all likelihood, they'll be in their highest earning years, the children, that is. It really just makes so much sense, and oftentimes it's going to be done in a way that is pretty tax efficient. So what I'll do now is once again jump back into my modeling environment, and I just want to show you, how some of these new rules around the OBBBA, as Debbie's now referring to it. I've heard that around. I haven't had the courage to use it yet, but we'll go with OBBBA. It can be modeled out. So, one thing, I actually included this just before the start of the webinar, because I think this is a really great point, and it really involves the disclosure of some of these new deductions that are available to clients. So what I did here was I just included a pre-OBBA and a current OBBA. So we can still model out the pre-OBBA environment. This is the TCJA with Sunset. And what I want to just show you is how, and I'll just pull up my Delta here. I want to show you just how, even doing nothing, no tax planning strategies required. These are exactly the same scenarios in scenario 1 and scenario 2, apart from the tax law applied to it. So that alone is saving this client almost $10,000. This is why it's so key to inform your clients of what's going on, why these, how they're benefiting from these new provisions, these new deductions. And this is what the CPA is going to point to if and when you make tax planning recommendations that for some reason jeopardize this additional $10,000 of federal tax savings. So with that said, what I want to do is just show you how that could really work in practice. So I have a couple here. They're sort of in maybe their last year of employment. Maybe there's some deferred compensation paying out. They want to get started on Roth conversions. I just have $500,000 of income here. This is the very beginning of that SALT deduction phase out, and a $100,000 Roth conversion in scenario 3 here. So I'll open up my worksheet here. And this is exactly what Debbie was talking about earlier. These folks are in the 35% marginal bracket. But because their income is increasing while they're also losing deductions, their effective rate on this $100,000 Roth conversion is just under 43%. So, what would have been maybe a $35,000 tax consequence for a Roth conversion like this is now a $42,000. You throw state taxes on top of there, now they're suddenly, close to 50%, maybe even over 50% tax rate. This isn't, this is maybe on the more extreme end of things, but a scenario where I see this particularly prevalent could be that enhancing your deduction, which that's not just a standard deduction. That could apply to people who itemize as well. So that's at the lower end of things. The SALT is sort of in that $500,000 to $600,000 range in terms of income before it's phased out. The enhancing your deduction is much lower. For a married couple, that's $175,000 to $250,000 of MIGI. So that one in particular, you could see a lot of if you're making recommendations for Roth conversions to clients. So with that, I want to quickly just look at how a QCD could be beneficial. So we discussed this a little bit. Obviously, in 2026, we have that 0.5% AGI floor, and also the 35% cap for offsetting income when taking a charitable itemized deduction. So because of that, what I want to do is just show you this is a really great tool just built right into the scenario analysis tool. So we don't have to, do any fancy footwork here. We can show you exactly what a QCD is going to look like as opposed to a direct contribution, or rather a distribution from an IRA, and then a subsequent taxable itemized deduction for charitable giving. So here I have Mary. She would have had a little over $330,000 of RMD. But if we can maximize that qualified charitable distribution, obviously just charitable giving in general is going to save money, but the comparison of QCD versus an itemized deduction is going to save her an additional just under $6,000. So scenario analysis, this is the place to be. This is where you're going to model out these recommendations and show clients the impact of some of these tax planning strategies. All right, we're going to move on to our business owners. And this one I think is a really great scenario. And in order to set the foundation a little bit, what I want to do is just jump back to a cover page here and show you a little bit of the background of these individuals that I'm going to be modeling in the software. So this is a married couple in New York. Total income of $780,000 in 2025. Two children, they're in their mid 50s. They have a net worth of about $15 million. They've done very well. The business produces a lot of income for them. What are the planning solutions we're considering? And one in particular that I want to highlight, maybe they've never established something like a qualified plan. Maybe they've been doing a SEP, which is a great strategy, but it has its limitations. So, as we sort of see the background here, I will jump into Mr. and Mrs. Fortune and show you what we can do for them and how we can illustrate some tax planning strategies within the software. So I'll go into Robert and Roxanne Fortune here. I've created a scenario here. And as this is pulling up, so I have their base case here. This could be based on the 2024 tax return. Maybe this is a client you work very closely with the CPA. You get current numbers. You can build this scenario with those current numbers if you have those available to you. So I'll scroll down here, and it's all coming through a Schedule C income. And as I'm scrolling down, I just want to highlight, where these numbers are coming from. So this is our base case. Again, maybe they have a SEP, maybe they don't. In this case, I'll just show what it looks like without a SEP, without any sort of qualified plan for the business owner. The middle scenario here, scenario 2, this would be, hey, let's set up a 401k, let's set up a profit sharing plan and see what they can get. So the two of them together. This assumes that each of them is just, they're the only employees, so we don't have to worry about things like testing for discrimination across an employee population. They can get $77,500 each into a 401k profit sharing plan. Compare that to a SEP, which is $70,000. So we're getting a little bit of benefit off the top there. That's a great tax savings. I'll show my delta here. And I'll just scroll to the bottom so we can see exactly how much that's saving them in taxes, $64,000. So we'll take it even a step further. Again, this is just building on. This is why scenario analysis is so helpful, is that you can quickly put these things together. So if you've never delved into cash balance plans, I'll give you sort of the high level. In this case, what's included in this $250,000 each is that $77,500 base for the 401k profit sharing plan, plus about $175,000 each toward a cash balance plan. So two individuals in their mid 50s who have been high earners their entire lives, have this very successful business. These are pretty reasonable numbers. You're not going to calculate these numbers. A plan administrator is going to do that. Someone who's very smart with lots of letters after their name, like our host, Debbie Taylor here, is going to calculate those numbers for you, and they're going to give them to you. But just to give you a sense, this isn't made up. This isn't pie in the sky. These are pretty realistic numbers that could apply to a client in a similar type of situation. So I'll go down the line here, but I want to call out just a couple of things here. First of all, because of their level of income prior to these retirement plans, they were being capped for the SALT deduction. So They were at most being able to take $10,000 of deduction for their state and local taxes. Because we're bringing their AGI down with these retirement plan contributions, we're actually phasing them into the SALT deduction. So, you hear a lot about, don't phase your clients out. Okay, well, in this case, we're actually phasing them into the deduction. So right off the bat, we're getting them additional deduction because of that. At the same time, we're also phasing into QBI deduction. So there is a dual benefit here. Not only are they getting the SALT deduction, they're getting the QBI deduction as well. Moving on down the line, you can see here we're talking about $170,000 tax savings because of this 401k profit sharing and cash balance plan contribution, and significantly bringing them down in terms of marginal bracket. So this is really the power of scenario analysis, just being able to show this side by side very quickly. To say that this took me maybe 10 minutes to create these types of scenarios. Obviously, you're going to have to get a lot of these numbers if you're doing a cash balance plan from from an actuary, from a plan administrator. But being able to illustrate this to clients is so impactful. And so, it's provided to the masses because of how simple Holistic Plan makes it. So another scenario that I did want to just call out is, and we actually have a recipe for this. So I'm going to open my cookbook and show you this is an LLC versus an S corp. So with that, I will jump just right back to my household for this client because I've created a scenario. Um, Again, without getting too much into the weeds, this is perhaps the CPA's job. This is something that you're going to want to have them discuss with their CPA. But coming back and illustrating it for the client can be very impactful. So this is a couple. They have $200,000 of income flowing through their LLC. So it comes to Schedule C. What we would suggest, and again, I used scenario recipes for this. So if I can do it, you can do it too. Would be to, instead of taking everything on Schedule C, maybe we put some of this income through as wages. And what that will do is shelter the rest of the income from self-employment taxes. So the remainder of the income flows through Schedule E, less the employer covered portion of Social Security and Medicare taxes. And what I'll scroll down and show you here is just that tax savings. And what I want to call out here specifically, Holistic Plan is smart enough to know that the business is going to be picking up $77,650 of those Social Security and Medicare taxes. So here's our comparison, that tax plus FICA, and that's about a $15,000 tax savings. Which makes sense because 12.4% Social Security plus 2.9% Medicare, that would be your self-employment taxes on that $100,000 of income that is now shifting to Schedule E. So hope I'm not putting everyone to sleep. I think I hear snoring, but hopefully hopefully we see the value of this tool and why this is by far what we're focusing on and how we use this tool for clients throughout the year. So with that, Debbie, I will flip it back to you, and we'll get to some takeaways. Maybe we have some questions to be answered.
So the chat was responding to your humility and empathy. And so we have some people saying that they're not snoring because they don't snore. So I'm not sure if that's actually a good thing when you really think that through. And so folks really appreciating. Look, I mean, I got up there and I talked conceptually about, hey, maybe we need a change in entity, right? These are some of the things we've got to be thinking about. And you're basically, demonstrating, what Holistic Plan can do with that. So I think it's great. I think it's great. So thank you, Greg. And so let's go through the key takeaways, and then we wrap this part up, right? So like we talked about, OBBA brings opportunity and complexity. I got somebody from DC in the chat saying they're calling it like OB3 or something like that, right? But people do everything differently in the Beltway, right? So OBBA bringing opportunity and complexity. We talked about the 7 primary planning areas, so I went through that. Greg did a nice job with the scenario analysis, so no drive-bys, right? Let's roll up our sleeves, let's train our team, let's create processes around this. And I have done a ton of work in those monthly masterclass series and the others, sort of going through the processes. And, Greg's been a great help also with that. And then let's think about different segments of your book and maybe do some outreach with them, or maybe even when you're sitting with them at their year-end appointments, and have ideas about what you're going to talk with them about. And then towards that end, then our bonus material is FP Pathfinders coming out with a really nice piece that breaks up some of the key areas of OBBA. And so I think this is actually a great start for you in these year-end meetings or in putting together outreach to your clients. And then, I think we went through some things earlier on in the session. And so with that, then I think we're going to hand it back to our friends at Holistiplan. And thank you for the opportunity, and thank you everybody for hanging in there to the almost the bitter end. So thank you everybody.
Yeah, thank you both so much, Debbie and Greg. It is always a blast learning from you both. Greg, I know you are not alone in learning about that Delta feature a little bit maybe later than you should have. I saw at least 2 comments from people today who that this was them learning about it. So I know you're not alone. Debbie, if you're not already on TikTok, I think you should be. Kate and I both agreed that your sound bites would absolutely go viral. Both the content and just the out of context quotes. Incredible.
Yes,
Host to plant the crock pot, that's amazing.
I've never been on TikTok, but my daughters are on it. They watch like all kinds of crazy stuff. So maybe we'll start like our own little PR thing on the side here. Me coming up with these like random expressions. So anyway, thank you. Thank you. It was nice of you.